Hello and welcome back to my 10 favorite people. Hope you're doing well. I'm incredibly excited for today's video because while everybody has been on an emotional roller coaster over the past few weeks, we've managed to remain calm and collected because we're familiar with Bitcoin's summer seasonality, and we knew that no matter what the hot new narratives were, Bitcoin was likely going to have very choppy price action during the summer because that's what we've seen every single summer for Bitcoin outside of those post-halving years of 2017 and 2021, and so far this summer's price action is exactly in line with our expectations. And of course, we're open to the scenario where Bitcoin ends up having an early breakout before the October timeframe, and of course our line in the sand for that is the 20-week moving average. If Bitcoin were able to reclaim it on a weekly closing basis, we can start talking about more short-term optimistic price targets. And of course, we also have our failed cycle scenario that we're monitoring, where if Bitcoin were to lose the 200-week moving average, we would have to accept the reality that perhaps this cycle is in fact different and we're going to enter a prolonged correction that most aren't prepared for. But as I'm sure you're all well aware, the most likely scenario for me by far is the normal cycle scenario, where we have a couple more weeks of consolidation, perhaps one more big shakeout. And there's a lot of reasons for this. For one, September is the worst month for Bitcoin historically, and we know that we're entering September in just about 3 or 4 days. We also have the election uncertainty that's going to pick up as we approach November because we've seen increased volatility in the S&P 500, and as a result, all risk assets as we approach November in election years. And I expect this to be especially true this year because of how close and contested this election is. And of course, we have to add the monetary policy uncertainty. We know that Powell gave us some good news at the Jackson Hole meeting that we're likely going to get a rate cut in September. But of course, this is only going to be a 25 basis point rate cut, maybe a 50 basis point rate cut, which perhaps some investors are going to view as bullish, but a lot of people are also going to view it as a sign of concern because in the two most recent cutting cycles, if we ignore 2019 when rates didn't really get that high, we saw market corrections and recessions coincide with rate cuts. So a lot of people view rate cuts as a concerning signal. But of course, you guys know I don't necessarily agree with this because we've also had rate cutting cycles that lead to the market rallying and that happen a year plus before a recession ends up hitting. So I don't think it's reliable to look at just one variable, which is the Fed interest rate, and try to decide what markets and the economy are going to do based on that information alone. So because of monetary policy and recession uncertainty combined with election uncertainty and of course Bitcoin's seasonality in September, I'm being very cautious going into September, and I'm open to that last shakeout playing out before we can really start our next rally. Now, the good news is we did see quite a bit of inflows come into the ETFs after Powell gave his speech at Jackson Hole. And this is great because we know Bitcoin's main narrative is as a money debasement hedge. So it's nice to see investors buying Bitcoin when we see easing on the horizon and see more dovishness coming from the Federal Reserve. And it's very impressive to me that even though Bitcoin has been correcting and consolidating for the past 6 months, we're still at all-time high balances held by these ETFs, which shows that a lot of these investors are a little more long-term oriented and they like buying Bitcoin when they're expecting the Federal Reserve to ease because they view Bitcoin as a money debasement hedge in the long term. And that's the exact narrative we would like to see. And that's why I still think this is a multi-month reaccumulation phase like what we saw in 2020, in 2016, and in 2012 before we can really have our next major expansion, perhaps starting in Q4 of this year in October or November once the election uncertainty is behind us. As for the labor market data, we know this is a huge driver of the Fed's monetary policy. And although there's been a lot of investors that are incredibly concerned with the increase we've seen in the unemployment rate recently, I don't think it paints the full picture. I monitor what's happening with initial jobless claims each and every week because we get an update every Thursday. And if you look at the past 2 recessions, yes, it was a major warning sign when the unemployment rate got above its 2-year moving average. But notice that at that time, initial jobless claims, which in my opinion is the best proxy for layoffs, they were sitting at about 360,000 plus per week, when the economy was entering recession in 2007, in 2001, and of course in 1990. But if you look at where we are today, weekly initial jobless claims is actually very, very low compared to what we saw in previous recessions. And it makes me think that perhaps the unemployment rate isn't telling the full story. And maybe the unemployment rate is going up because more people are entering the workforce and not because people are getting laid off, like what we saw in 2007 and 2001. And of course, the only way to know for sure is to continue monitoring the data. But as of right now, I'm not that concerned about the labor market because we aren't even at cycle highs for initial jobless claims yet. And even though we see some layoff headlines here and there, I don't think we're anywhere near recession territory. And we're going to monitor this closely and perhaps get more concerned if it gets back above its cycle highs that were set in around June of 2023, when a lot of the major tech companies were doing layoffs. But as of right now, it does not seem like a lot of layoffs are happening, and perhaps something else is heavily impacting the unemployment rate. And of course, alongside labor market data, the Fed has to keep an eye on core PCE, the inflation measure. And of course, we know that's the Fed's preferred measure of inflation. We are getting an update to core PCE this week, which I think will have a huge impact on rate cut expectations. So of course, we're going to monitor that closely. As long as core PCE has a 2 handle, I don't think there's too much to worry about. But of course, we don't want to see inflation start trending higher because that would be a huge panic sign for markets, because it would mean that rate cuts are going to have to be pushed back significantly and that perhaps we're entering a painful stagflation environment. So of course, we'll continue monitoring labor market data and inflation data, and we will get an initial jobless claims print on Thursday and an update to core PCE on Friday, and I'm going to see how those impact the September rate cut expectations. Will it be 25 basis points? Will it be 50? I'm sure it's going to change based on what those data prints end up coming in as. And of course, the Federal Reserve is not the only game in town. We also have the federal government, which is still running major deficits and using that to stimulate the economy. We are still at about 1.6 trillion in deficits for 2024, with about 2 months to go in the fiscal year. That's going to end in October. And we have to keep in mind that the same thing happened in 2023 and 2022. The federal government is doing a ton of spending while the Federal Reserve is keeping rates elevated to fight inflation. So once the Fed starts easing again, while the federal government is still having this insane spending, I would expect that to put quite a bit of upward pressure on the M2 money supply, now that its leading indicator, the US government debt, is well ahead of it. And of course, I think there's a very strong correlation between the US national debt, the money supply, and the S&P 500, because over the past 35 years, we've seen a clear increase in the S&P 500 as the national debt has increased, and the slope of both has gotten steeper and steeper with each crisis that has occurred. And of course, we always talk about the S&P 500 because it's correlated with Bitcoin, and Bitcoin needs the S&P 500 to do well if it's going to do well, and investors are going to take more risk in a riskier asset class like Bitcoin, because we know how important dollar devaluation as represented by the dollar index is for Bitcoin. We're still sitting right on the edge of this risk on zone, but as I'm sure you're all aware, we're expecting a bounce off the 200-week moving average before we really get a true breakdown over the next few weeks. And we know how important the dollar index is for Bitcoin, because mania phases in Bitcoin were driven by the past 2 prolonged devaluations in the US dollar index. And of course, that's when we got our alt seasons as well. But for now, we remain cautiously optimistic because we know that although it's unlikely Bitcoin can still retest that low 40Ks region, we know that being open to multiple scenarios is the best way to navigate markets. And although I still think Bitcoin is in a fair value range, I would love to see a retest in the undervalued region for me to actually deploy some cash and take advantage of those lower prices. But of course, we have a lot of volatility ahead of us with September seasonality, election uncertainty, and what that tends to do with volatility, and of course, monetary policy and recession uncertainty as well. So I expect a lot of excitement and volatility over the next few months, and my base case remains the normal cycle scenario, where Bitcoin either retests the lows or puts in newer lows and maybe even gets another test at that 200-week moving average. But as long as we don't lose it, I remain bullish and optimistic over the next 6 to 12 months. But of course, we'll continue to monitor this as time progresses. For now, Bitcoin is sitting right between resistance at the 20-week moving average and support at 61.5K, which was Bitcoin's multi-month range low. So this is a pivotal week for Bitcoin. And of course, we'll see what happens and we'll see what we end up getting with the initial jobless claims number and the core PCE print this week. But of course, let me know what you expect. Is Bitcoin going to lose the range low once again, or are we going to be able to reclaim the 20-week moving average? And of course, let me know what cycle scenario you think is most likely. Are we going to have that early breakout before October, or is it going to be the normal cycle scenario, or is it going to be the failed cycle and we're going to have a lot of pain ahead? Would love to know what you expect. As always, thank you so much for the support on the recent videos. Thank you so much for watching, and I'll talk to you soon.